Hello, everyone, and welcome back to another West Bank Financials interview. Today, we are joined by Caleb Tannehill. Mr. Tannehill has had a very lustrous career in finance, ranging from experience in investment banking to private equity. And I guess to start off, Mr. Tannehill, could you please tell us a little bit about yourself, your experience in finance, and how you got to this point?
Yeah, absolutely. I started my career in finance in call it the retail commercial banking sector after graduating undergrad degree more in I guess you'd consider pre-law and public policy. So as I was kind of trying to figure out kind of which direction I really wanted to go, I figured the banking sector is a great sector to learn in. It touches many areas of finance. And so that just seemed like a great, starting place personally for myself. Well, ultimately, I knew I was probably going to go back and do my MBA in finance, and then, look to go, as you mentioned, in investment banking per se. So, was in that sector for 2.5 years. Ended up going back to TCU where I did my MBA, and then completing my MBA, I ended up in the investment banking sector. And so that was a good experience. My team was more of a generalist team, so we weren't sector specific. Some banks and some groups within the banks have certain sectors that they cover. I guess I was lucky or blessed, whichever way you look at it, to be able to cover many different engagements, spanning, anything from a real estate divestiture from a Hong Kong bank to family entertainment, SaaS, crypto, you name it, we saw it in some capacity. So anyway, after almost 2 years in investment banking, I had a great opportunity with my partner now to launch a private equity platform. And so that's where I spend my day-to-day now.
Awesome. So definitely a pretty diverse career in finance, ranged from, I guess, investment banking to now private equity, which is amazing to see. I guess the first question I'll start off with is, like, how did you, I guess, break into investment banking, coming from like previously like a pre-law undergrad major?
Yeah, so I knew I'd have to go back and get my MBA specifically, and then try to figure it out from there. And so the end goal, or where I knew I kind of wanted to end up ultimately, was within the private investment space, call it. So whether that's private equity, venture, um, and so I guess there's really two routes. You can go consulting, you can go investment banking, and luckily TCU, they had a consulting, I guess, program that you can join. And so I did 6 months working with GM Financial on a consulting project. And through that experience, I really learned that I really liked the finance side of the business, more so than call it the management analytical side in some capacity. So both of them require, whether it's consulting, investment banking, you're doing quite a bit of analytical work. It's part of the job, but obviously the investment banking leans a little bit more capital markets. You're working with, the C-suite in a different capacity, depending on the mandate that you have. And ultimately, I felt like that's the area that I was leaning towards. And then what you find out most as you start working through your careers, in some capacity, your relationships help you get from one place to the next. And so at that point in time, I had a friend who introduced me to David Wield, who is the founder and CEO of Wield & Co., which is the investment bank that I ended up at. And although I was starting, call it my investment banking career, I did have, a few, past experiences and relationships that added value to where the bank was trying to grow. And so a little bit untraditional route in terms of even how that, call it investment bank operated, but was a great start where, it was a lot of trial by fire. But ultimately, yeah, from the call it commercial retail banking side, MBA, and then ultimately found the right investment bank where I had the right relationship to get started.
For sure. So you're essentially able to like leverage your network to get yourself into that role and use your experience for good.
Absolutely.
A question I had about that was, did you find like the content in your MBA program, did that correlate to like your like real life experience in the job, or was it more like theoretical concepts or?
Well, day one, I realized I forget what the assigned task was, but I realized I was like, wow, this MBA feels like it has no value to my life. And so there's some things in your job that you're going to ultimately, you just got to go learn and figure out. But absolutely, I would say to me, the MBA is the most valuable degree, call it in the marketplace right now, in terms of if you're going to go back and get a master's per se. Uh, there were obviously lots of just the blocking and tackling of finance 101, and getting your hands, an intro into modeling, for example, and learning how to run a DCF and all those types of things that are absolute fundamentals, especially in investment banking, that you have to do. So yes, the MBA definitely gave me a much better, stronger foundation than my undergrad degree. Through undergrad, I didn't touch Excel one time. So yeah, that you live in it in the investment banking world. So and private equity. So absolutely.
I see. And I guess regarding the network part, did you what like advice would you give to someone like who's maybe in college or an MBA that doesn't have those connections now? How do you think they should go about it? Because a lot of people come into the finance space, maybe like they'll start in college or in either their MBA without any previous experience or connections.
Yeah, like the alumni networks are extremely helpful. I always volunteer back right now with TCU and their MBA program, in terms of they'll assign a student and that's within finance, and so number one, find those opportunities where you can get some one-on-one in some kind of mentorship type program, or something like that, because then you get isolated time, and more than likely you start building a one-on-one relationship, and then that'll help kind of build into helping, hey, go talk to so and so, they might have an internship or they have a job opening, and then you can give a personal recommendation. So if you can get a personal recommendation, that obviously goes a long way. um, Outside of that, the clubs, generally every business school, university, college has a finance club to some extent, and they'll bring in speakers, and so like always try to go up and introduce yourself and meet them, if you can, and then also just within whether it's the campus events, just other kind of events that they bring a speaker in, just generally, that usually brings in people up from outside of the school as well, and so it's always a networking opportunity. And then just like more specific to like what you're looking to do. I think there's uh, TCU started a venture capitalist network, and so that's one where it's like you can go meet people who are actually in the venture community locally. So finding those opportunities, like, and what I always tell people, I learned it through my own experience. Someone gave me this advice. While you're in college, you can write a CEO an email, a note, and generally they will never, tell you no. And so whether it's a quick phone call or a quick coffee or 10 minutes at their office, generally somebody's going to give you some time. And so that's part of like more the creative networking side, where you just got to go kind of beat the door down depending on what you want to do. But yeah, I always say like go start, see what the university has to offer within the business school or specific to the finance department, what they're hosting on campus, what speakers are coming, and then just like reaching out to different people, and then obviously alumni fit into that bucket. Figuring out on LinkedIn, I'll get a message every now and then that's like, go frogs type of deal, and just, can I have like, 30 minutes of a call to talk about X, right? So I think those are the kind of the low hanging fruit, opportunities. That's just time and effort on your own to go figure out, how you meet, different people and stuff. And then from there, you can like dial in a little bit more specific to career or what you're wanting to do per se. And then that's figuring out like what alumni are at this company, and then trying to target those individuals. But yeah, I couldn't reiterate enough. While you're in school, it goes into your favor way more than once you graduate. So there's a lot more. I don't want to say charity given, but a lot more grace in terms of, well, I give my time to this person as part of giving back.
For sure, I definitely agree. I'm only a high school student now, but I definitely have noticed that that's something, or age can be something that is like easy to leverage. But yeah, on another note, like when you mentioned, I guess like these early networks that you built, did you sort of like form any like sort of mentorship relationships with people, or like find any mentors that still to this day maybe help you out potentially?
Yeah, I mean, I would definitely say like I had one influential relationship help me get my job in banking, and then was very influential in, if you're trying to get, into private investments, then you need to go back and get your MBA. And then leaning on their advice, this particular individual had a consulting career previous to them going to private equity. So obviously, I went the investment banking route and then back over. So definitely I took the advice of one individual who, was already kind of at the top of the field, and kind of where, I'm trying to get, and just ran a game plan according to what they said. And so, yeah, I think there's huge value in whether it's one person or a couple people that you can listen to and just hear, obviously their story. Everyone has a different story on how they got from, A to B to C. But then just figuring out like when they tell you you should probably go do this, then like really leaning into that advice, And so that's what I always tried to do was, um, you know, against my own feelings. If they're saying go do this, then go do it, So yeah, that's probably was most helpful to myself. And luckily it was, one individual who was more formidable on that thought process.
For sure. So sort of like building trust in that relationship and like really heeding their advice and taking it seriously. Yeah.
Absolutely. Absolutely.
Sure. And may I ask, like, I guess sort of what made you transition into private equity? I know it's like a very like common pipeline in finance, but
Yeah. Well, so once you go, a couple years into investment banking, you start getting, different people reaching out to you. So, yeah, as I was saying, I was coming up on 2 years, and um, I'd hear from different investment banks here and there and different other opportunities. And then my partner, who I started Three Bay Capital with, Scott Lucina, he reached out to me, and one of those deals in terms of wanting to build and scale out a platform. He was previously running what you'd consider a private family office here in Dallas, and so um, changing investment, having a different investment thesis than he was running internal with the family, and wanting a partner to go help him build that. That was kind of the offer was, hey, we can go build this together in a true partnership form and fashion, which gets you more on the entrepreneurship side. So a lot of folks, it's, there's a very, identified track in investment banking, right? In terms of if you stay internal, everyone knows, analyst, associate, director, managing director, that's kind of the internal route. And then going outside of that, you might be, if the undergrad analyst to, analyst on the private equity side, or if you're a little bit more senior, you might get, a director role or something of, that form or fashion. And that could be with a larger, think about your larger company is like a KKR, for example. And so at that point in time, your compensation generally gets, pretty nice. So I guess you could say I made a bet more on myself and my partner to say, hey, economically go for more ownership within a company, and then you're in charge of building that and scaling that. And that was the more attractive offer, to myself. And so, Yeah, so instead of looking for more, call it an established, larger, you know, brand name, for lack of a better term, I ended up saying, hey, look, I'm going to go with somebody a little bit more senior. There's, close to, a 25-year age gap between my partner and I. So I was looking for the mentorship, who can I learn from? How can I sharpen my skills? And where can I have, the ability to contribute and be in charge of, investment strategy, at the end of the day. And so it checked a lot of those boxes, obviously. And then, you go home, you tell your wife you're doing this, and she's either like, you're crazy, or, okay, let's go do this. So luckily I have great support.
Awesome. That's like pretty great to hear. I'm like in strong support of any entrepreneurial venture, especially in the finance space, because I know a lot of people sort of stick to the like standard career pipeline. And like regarding that, I do have to ask, like, what are some of the barriers eventually, or I guess like difficulties you face like early on? Because I mean, scaling any sort of venture in the PE space is relatively difficult.
Yeah, I mean, I think we're still young in terms of the lifespan, obviously, of our platform. I mean, at this point in time, we're about, call it coming up on a 2-year anniversary. And so, yeah, and I'd say we went about it in a little bit of an untraditional manner in terms of how we decided to launch the platform. And so we ended up going with a fund structure first, and then ended up kind of bending back to saying, hey, we're just going to do more direct deals. And so, we have, call it large network of LPs. And so the challenge, I would say, to kind of answer your question is when you choose to go, capitalize deals on a deal by deal basis per se, you're going to have some LPs it works for and then some it doesn't. And more some of kind of the macro environment we've been in, call it the last, 2 years, a lot of headwinds. You look at the capital markets and trends of folks raising capital from 2015 and deploying through 2019, a much more generous market, to raise capital and to deploy capital. And so obviously in today's world, 2025, one of the, topics in terms of illiquidity is folks' capital locked up into different funds, right? And because of valuations, it's caused, firms to hold companies they invested in longer, and not having the exit opportunities via mismatch in valuation. And so a lot of what you consider your, LP investor network has jammed up liquidity. So I would say that's probably one of the larger kind of headwinds, has just been the macro capital market, over the last 2 years, and trying to find the right opportunity that meets the right need of the investor per se.
I see. And then I guess this is something you mentioned like earlier on, but what sort of motivated you guys to transition from like the standard fund, I guess, structure to direct deals?
Yeah, I think one thing we're always aware of is listen to the market, take the feedback, and implement. And that doesn't mean you have to change your strategy, your plan. But what I guess if you go back to call it winter 2023 into 2024, lots of uncertainty in the market. You're still kind of coming out of COVID, and you're really competing with, CDs at that point in time. And so a lot of people don't do the work to figure out, okay, well, net of my taxes, like, okay, what's my net return, right? And so even in some of those, CDs, you net out, your tax obligation at the end of the day, and it's below a 5.5%, percent. So that fund was more real estate focused. And so when you look at kind of the hurdle rate, or the, preferred return that you'd have to make to your, call it, LP investors, you have because without going into all the details, you had an accrued preferred return, and then once you recap some of those assets, then you're making, you're catching that up plus making the real cash distribution. So we are competing with a 5.5% CD rate, versus, hey, we're going to accrue this. It's appreciating, but you're not getting, call it whether it's 3, 6 months, you're not getting your capital back, like a guarantee, return back, like you would with a CD. So that was, uh, you know, going through that exercise to figure out, okay, can we capitalize the fund, or can we just capitalize deal by deal, opportunities? More feedback we were getting personally with, our investors was we would prefer to look at them on a one by one opportunity as it comes versus going in, although it wasn't a blind pool, going into a committed pool where we're, locked up for, 5, 7 years. So that was probably like the real differentiation on why we ended up going away from the fund, and looking at everything more so on, each opportunity that comes.
For sure. And then you mentioned like in the past, like direct like real estate deals, but like what other, I guess, sectors are you guys involved in?
Yeah, I think like where our minds are right now is we're really agnostic to geography industry. So really, it's how can you extract value within the marketplace. Sure, we have certain like return hurdles that we look at, but I think right now we love, real estate plays a factor, private credit, which kind of goes between real estate and direct, operating business opportunities. And then, you call it private equity venture, right, which is more focusing on uh, investing into direct opportunities, right, at the company level. So that spans, a whole lot of different, sectors. And so we really like energy. I think we were looking at it earlier today in the pipeline. I think we're underwriting close to, $600 million of energy deals. So that one we're, super, super bullish on. And we think into next year, if you look at, consumption and energy consumption, we need a lot more fuel to get us there. Whether that's, call it traditional, oil and gas, E&P. So we've been looking at an opportunity there. And then you swing the pendulum all the way to the other side of like nuclear, for example. There's a lot of different, opportunities that you can, try to find good, good deals and different management teams or companies that you want to back. So that's been a segment. I mean, we've probably, geez, off the top of my head, I don't know. We've probably looked over 20 to 30 different sectors, just this past year. But definitely energy, just based on, probably what this world needs in terms of, data centers, crypto, just standard. Most people don't know. More than Bitcoin mining, there's more energy consumption with Netflix and your washer and dryer. So definitely everyone's going to want to wash their clothes, and everyone loves Netflix. So to keep all that stuff on. So anyway, but yeah, I mean, really open just to a whole host of opportunities. But those are probably some segments that come top of mind, especially in the private credit. One of our companies, Equidot Homes, that's more of a lending platform. So own the company, but then also we're originating loans for folks who either can't get traditionally financed through a bank, or as we just saw this stat, within the week, that the cost of mortgage has gone up 70%. But if you look at salaries, especially in the U.S., those are relatively flat. So there's going to be more people who need some alternative form of finance to, finance a home. And so we think we'll, be able to pick up some tailwinds there. So that touches a little bit of making operating investment in an operating company, as well as, being on the lending side as well. So we really like that opportunity, and are going to really spend some time scaling that company. So, and then on the real estate side, we love the gas and convenience store sector, private aviation, and hangar development. We are looking at a development in the Pacific Northwest. Right now, we don't think development is great, because of the cost to develop. But this particular opportunity has great potential to be a trophy-like asset. And so just being able to go compete for that asset, we find it a very attractive opportunity. So, and then multifamily. I mean, residential, people always are going to need a place to live. And so just making sure it's, in the right market, buying at the right basis. We look at a number of those opportunities as well. So very open, to sum it up, very open on the private equity space. Really comes down to, a few underwriting metrics, and do we feel like we're getting, a great, value over time. And then call it private credit and real estate. So.
For sure. And I'm actually really glad you mentioned energy, like especially with like artificial intelligence as well. Like that seems to be like every person seems to be trying to make their own LLM now, or at least wrapping GPT. So that's definitely going to increase energy usage. But yeah, another question I had about that is like outside of like general fundamentals, how do you go about, I guess, more like financial analysis, especially of like smaller companies and like how that goes into like underwriting? Because I know like me personally, I have more experience like in the public space. Like I don't know as much about private like equity in general or private credit. So I was wondering like how you go about, I guess, valuing a company, whether it's like standard DCF or DCFs or something else.
Yeah, and the classic, I think it dependent on the company, right, and what they're offering. On the investment banking side, we didn't do any, public, whether that was, taking a company public or any public M&A, for example. So most of all my experience was really in the private markets, which tends to be a little bit more difficult in terms of when it's a publicly traded company, you have a lot of public information, right? And so, whether you're doing, sure, you're going to, try to run a DCF to get the value of the company, to get the value of the stock, or, precedent comp, analysis. You're going to wait, a few different valuation methods to get to, a total valuation using a couple methods. I would say, on the private market side, there's a little bit more of, the qualitative analysis comes into play. We have kind of like a pretty robust checklist that if we're going to go, look at a company and say, hey, look, like we've talked with the management team, we believe the investment is going to meet some of our return hurdles. And then overall, we think we're going to get to an LOI, then we'll usually, give the company this checklist, which is, a pretty in-depth look of the company, trying to understand, what does the company do? How do they make their money? Who owns what, of the company? Who can make decisions on behalf of the company? Who can approve, the sell or purchase of the business? What technology are they using internally? Who are their vendors? Who are their customers? Really, where are they getting their revenues from? So it's pretty comprehensive in terms of how in depth we'll go. But yeah, I would say generally, and then each company, they usually, whether they have an investment bank representing them or internally they're running a model, they've put together a model with their financials, depending on the size of the company and, how they're structured. They might have somebody in-house who's been able to do that. And then it's just really like diving into that aspect and then running our analysis to say, hey, like, do we agree on the view of your business and whether that's where it's at today in terms of what you believe it's worth? And then ultimately, do we agree internally from our perspective on where we think we can help drive company growth and get it to? So, from our perspective, it's more than just writing a check. We try to find those opportunities that, via our network, our relationships, can we help scale the company with new customers, bring in new technology, enter new markets where they might not be operating, today. And if we can help do, some of those things, be a little bit more, hands-on and involved with the company. That's generally a good sign for us. Some of the opportunities we do look at is just simply we love the business, we believe in the story of it and where it's going to eventually grow, and we wouldn't mind owning, a certain amount of that, upside. So it is a little bit dependent, on the company, but yeah, in terms of looking, how do you value it? It's a mix of, your typical fundamental analysis, running your models, and then also, just getting to know the people. I think I heard a quote. I was at an investment lunch, probably within the year, and one of the individuals speaking, he made the comment that 99% of the deals that have gone sideways have never been done or have never been ascribed to internal to the company or a wrong assumption we made. It came down to people. And so that's where, us specifically, whether it's, a capital partnership or partnering with a management team, you want to get to know them really well. And especially like once you get this, you start negotiating, the purchase of the company, it generally emotions rise, right? And so it's always good. We like building relationships in real deals, because then you get to see how people truly operate, and that helps you kind of get to know somebody better. So that all kind of folds into, I call it the diligence bucket, um, and how we try to run an engagement. So.
For sure. So generally like more stronger emphasis on like not just like the fundamentals of the company, but also like the team and the actual like people running it, to make sure you have like a personal connection. And if conflict arises later, company's not gonna go belly up. But I guess related to that note, what are like some, I guess, like indicators that like when you're looking at a company or screening a company that it's going to do well, whether that's like fundamentals or the team? And it's kind of hard to generalize because each company is
Yeah.
different.
Yeah, I mean, it is kind of like between sectors, like for example, we're looking at one business where, uh, they have like 3 million top line, and then, -8 million in EBITDA. Well, that company was like growing, and so they're right on the cusp of like, getting out of like the early stage startup mode. You have real revenues. They had real investors. Their technology was in the second generation, and then they had their third generation, um, in development. And so from our perspective, they were right on that, call it like year and a half transition point to where they were really going to become a more mature, stable company. So then when you look at, call it the projections of that business, you can see, revenue starting to stabilize, your expenses, starting to go down, units into the marketplace. So, your product being purchased more, call it your G&A, stabilizing, which then allows obviously that EBITDA margin to, kind of increase, and we looked at that on, part of our, thesis is, do we want to hold this company for, 7 to 10 years? So we would take, because of, I'd say probably more of our background's experience, more of that kind of family office approach to investing where, we will be a long-term capital partner if we say yes, versus, hey, we need to, extract, pinch margins as, much as possible and sell the company in 5 years, at all costs, right? So a little bit different kind of mindset around investments, but ultimately, we like to look at, return on capital, so how efficient, with the investment made, is that, company being, we have, minimum, IRR return thresholds, dependent on, industries. It gets a little bit more difficult in terms of, what multiple are you looking for, at exit per se, depending on the sector that you're looking at. So, and then just within the environment we're in, some of those multiples have been compressed a little bit. So you really have to dig, to find the right opportunities. So in terms of like the larger kind of like investment return profile, I mean, those are, some of the things that, that we're thinking at, internal to the business, it's always for us, understanding what's going on with the business, right? So, trying to understand top line down to the bottom line. And then where my partner is really good is really understanding the cash flows of the business. And so at the end of the day, really trying to understand like how much money do we really have, because your free cash flow and net income can often tell, a much different story. So, yeah, I think in a real broad stroke, you have to look at each business independently. There's obviously, certain standards, across different sectors, in terms of what they would, say is acceptable. Is the business, does it have too much leverage? Can you put a little bit more leverage on the business, to help it grow? Do you have enough cash to make interest, expense payments, all that kind of stuff? Are we at risk of default? So anyway, I think that's, we really try to dive in and figure out, how can we, poke as many holes in this using your own data that you're giving us to figure out if it's the right opportunity for us.
For sure. And now that you mentioned like companies having too much leverage, that's something I never even thought about really. So that's definitely something interesting, and I definitely need to do more research on that myself. Aside from that, I was curious, like early on you mentioned like these companies that are sort of on the cusp of like long-term profitability or being like more of a mature company. I was wondering, for companies that are sort of like at that middle ground, do you generally like, what sort of deal do you favor? Because like I know private credit is generally like more for more mature companies, but like a standard venture capital investment is for that like early stage startup.
Yeah, so I think like when a company is kind of like transitioning and like what we look for, right? So good example, right? Where a lot of early stage companies will try to raise on like what they call like, like a safe or like a convertible note. And, from our perspective, like those are great internal instruments to have because, that individual owner founder is not having to give as much equity or ownership of that business, right? Face dilution. And so for them, it's wonderful. From our perspective, unless we really, really like that company, part of your rights that you'll generally have is obviously there's a coupon. Say you did a note, you're going to have some kind of coupon that you're receiving, somewhere generally between 6, 8, 10% on the high side, and then being able to purchase in at the next round at like a 20% discount or something like that, right? So for us, it's like, okay, are we going to participate now, and then do we want to participate further in the future in that business? And so that's why I would say we probably lean a little bit more into, call it like the growth equity stage, where the company, you kind of know your cap table. Some people might want to be taken out. There's going to be some dilution of management team. We're going to bring in the necessary capital to help the company grow and scale, and then take much more of an advisory role, with the company if need be, right? So I would say it's a little bit dependent on, at that point in time, the founder or like owners, desires and kind of what they see and where they want the company to go. Some are like, hey, look, this is 2 years and then I'm ready for my replacement, type, and they want to take some chips off the table. So yeah, I mean, we'll look at majority positions and we'll look at minority positions, right? It's just really dependent on that company and kind of the active role as the investment partner that they want us to take with them. But yeah, I would say that's like there's some little different nuances in terms of the different instrument or security that they're offering, whether, early on or, the company is a little bit more mature. And then depending on, sector and the size of the company, once you get to more like buyout where you're, fully buying the company out, generally you're writing a bigger and bigger check, right? So, what kind of capital backing do you have and the ability to, go buy, whether that's 51 to, 100% of the business, at the end of the day. So.
I see. So essentially varies according to the situation and how involved you are going to be in it. Okay. I guess, well, we only have like a few minutes left, but before we wrap it up, I have like two more questions. So the first one, which is sort of unrelated to the previous one, I was just curious about this. I was wondering what your thoughts on, I guess, like emerging markets, or at least on the private side, because I know in public markets, they've been performing, believe they've been outperforming like United States markets, partially like due to the macroeconomic situation we're in. But I was just wondering if that's reflected in the private side as well.
Yeah, I think like when you look at emerging markets, I think within our relationships and opportunities we've looked at, um, you have dependent on the individual and their viewpoint and their experience investing in those markets. Um, the hardest market I've ever had is Africa. Like anytime someone's like, "Oh, here's this opportunity, it's in Africa," outside of South Africa, I'm like, not touching that. Like, no, thank you. And a lot of the case, or some of the cases I've heard is, 50% of the population is going to be in Africa. So you have the most producers and consumers from population perspective. Well, you can go to Saudi Arabia and you can access, I think it's within a 100-mile radius, 50% of the global population. You have more money moving into that market. You have more established companies, big companies. You have an active capital market. Go there. You don't need to make this, huge outlandish bet on, future population growth. So if that's just one instance. India gets brought up a lot, within conversations. I have a friend who he invests exclusively into India on behalf of his family, and so you're very active. That's your day to day. That's your target. And then some locals, or their origin is originally from India, and they're like, whatever you do, never go to the Indian market. So yeah, again, it comes down to the personal appetite. We've looked at probably at least five, between 5 and 10 deals across the globe this year. And the only one that we were very, very interested, they were, domiciled in the UK. And so again, it's global for us, but, you kind of what markets, exist there. And then you're betting on the local team, essentially. So, I think like the other trend where it's not necessarily like emerging markets, but you're seeing like more like emerging managers. That's like a topic from, folks, whether that's more institutional investors, family offices, especially on the fund side, because as you grow your fund AUM, it's hard to generate, higher and higher returns, right? So if you go with some of these emerging managers, generally you can negotiate better positions in terms of economics, whether that's LP and GP economics, different rights, but generally speaking, on top performing emerging managers, you can generate more alpha out of their return profiles as well. So kind of a similar and why you'd want to invest in emerging markets. You can get, if you find the darling, within that market, you have a huge upside, get that asymmetric bet. But you can also achieve that kind of same return profile, different segment, but, in other kind of emerging, investments, or, criterias and segments. So.
For sure. So it definitely varies according to location. And as you mentioned, similar profits can be, I guess.
Yeah. And I mean, it's super hard to underwrite like geopolitical risk.
Yeah.
And like events that's going to occur. Like you just don't know when and where, certain things are going to happen. That's why it's like, okay, yeah, you can go to more established markets and try to get adjacent to some of those emerging markets, to where there's opportunities that you can kind of bleed into. But yeah, I think that at the end of the day is a little bit more difficult to say, hey, when you're sitting here in the United States, and then you have an investment like halfway around the world, it's not easy to, get on a plane and just go there the next day, and so the ability to, help the, pivot or, mitigate different risks, kind of go down from our perspective. So that's why in some of these opportunities that we've looked at, on a global perspective, the management team, and other investors, we generally like to see a really localized presence, or really strong connections, whether that's at the community level or at the governmental level.
For sure. And like you mentioned, I guess the geopolitical risks involved, it's like something you can't control at all. And like you mentioned, it's probably going to negatively affect like how you underwrite as well. And I guess your peace of mind as well. I mean, you're essentially investing in a
I mean,
company that,
I think we're on track for something like $1 trillion or over $1 trillion of outside investment into the US markets this year, which is, I guess, record breaking. And so that trend just tells you that people want to be in the US markets. So there's plenty of opportunities here. And so that's why it's figuring out, within the US, where can you call it, generate alpha, for your
yeah,
dollar. So, yeah, for us, it's hard to make a case to go out even outside of Texas, between Dallas, Houston, Austin, San Antonio, an economic boom. So for us, we're always saying, hey, we're sitting in those markets, why would we go look outside? There has to be a pretty compelling case. Um, and so, generally you're finding that because, somebody's calling you up that says, hey, look at this opportunity with us. And you're like, wow, that looks great. They were able to source a deal via their own network relationship that, they're having some kind of limited access to that we would never be able to get, sitting where we're at. So, but anyway, yeah, that's kind of, I guess, a little deviation from your question, but,
yeah,
we definitely feel that the U.S. is probably the strongest and best market still to be in.
for sure. I agree. I mean, there's a reason why like a majority of like the big startups and companies did start in the United States. But yeah, I guess before we wrap this up, I have one final question, which would be like what advice would you have for the youth or someone that wants to break into finance or maybe your role? Like how, yeah,
Well, the simplest investment strategy is go to buy a bunch of Bitcoin. You're probably going to do better over the next couple decades. But no, within finance, I mean, it's become highly competitive. I saw a report. I couldn't give you the stats right now, but just in terms of the numbers of funds that have, been active across the United States, from, I think it was like from like the 70s to like current day, it's pretty wild. And so, yeah, it's a highly competitive space. So I think it's always trying to figure out like where you're going to be interested in learning. And so you can go banking, you can go, um, credit, so more like alternative lending. Obviously, breaking into the private investment space is a little bit more difficult, to do right out of like undergrad, for example. But it really comes back. The best advice is, you know, go meet as many people as possible. Go try within your 20s, go try as many different jobs, to go see what you really like. I had somebody give me this advice that was like, in your 20s, try as many things as possible. In your 30s, you need to start, really dialing in like your skills and what you're really good at. And then in your 40s, you should be moving more into, call it management. And then in your 50s, and on, you kind of are leaning on everything you learned from your 20s through your 40s. So, yeah, I think there's not a wrong starting place. I think so many people have different stories on, how they get to their end point in their career. And ultimately it's figuring out, you're never going to enjoy your first jobs. They aren't the funnest. They don't make you the most money. But a lot of those people, whether that's a manager over you or, your peer next to you, they're all going to go on to do different things. So they are like invaluable in terms of helping you grow and then finding your next opportunities. So yeah, that'd be my best advice, especially people trying to break into finances. Just get your foot in the door, and then from there, you're going to start figuring out what you like, what you dislike, and then finding the right people to kind of help out and mold you, through the process and on the path, to getting to where you want to be. So.
For sure, and I completely agree. I mean, that's pretty much like my future, and I like especially what you mentioned about in your 20s. You have room to try things. I mean, I'm not in my 20s, but I'm assuming you have a lot of opportunity to fail and sort of get back up and restart again. So yeah, it's definitely some great advice that
I mean, as well. I think like in some regards, if you take the high points, of my life, you can see a linear pattern, but then when you insert all like the little missteps and the moments that don't work out, like you get that real, snake-like pattern, path. And so that's why it's like, it's not fair to ever compare yourself, to somebody else, especially like within their career, because at the end of the day, you don't know, ultimately where that person's going or where you're going or where you need to develop, where they need to develop, where you're stronger, they're stronger. So, that's why it's always, it's the most truest thing ever. Everyone knows you have to work hard, but the hardest thing to do is to remember to, put your head down and go to work, and ultimately that kind of helps build out, your opportunity sets. And that goes same with, the networking side, is meet as many people, go to as many events as possible, and kind of help build out, your network and trying to find your tribe of people who, you really enjoy, because all relationships ebb and flow. And I think that's where you're going to find like a core group of people that you'll probably be with for 20 years. And then you have those little relationships that kind of pop in and out. So trying to get to what we always like to say is, how can we get to a quicker no, or find, hey, look, this relationship isn't the right relationship to, to spend time building. In your 20s, you have I'd say a more of a habit of saying yes to everything. And so it's learning what to say yes and what to say no to. That kind of helps you meet your career goals more than anything. So I know it's a long rambling answer, but yeah, if I was going to sum it up, is, just get your foot in the door of a career. You can always, pivot out, find the people that are going to help support you, mold you, and figure out what is actually helpful for you, and say no to all the other stuff.
For sure. Yeah, there's definitely a lot of hidden gems in there, but like you mentioned, keeping your head down, focusing on yourself. That's like, I really agree with that. I mean, in the finance space, especially, because you'll see people like posting on LinkedIn or whatever, talking about their new internship, and it's easy to get lost track. But yeah, I completely agree. And also what you mentioned about Bitcoin, I'm a strong believer in the protocol, so that too as well.
We like to say, keep stacking sats.
100%. I think I don't remember exactly what it was, but the statistic was if you buy Bitcoin right now, 3 years from now, you will be guaranteed in profit, or something. It was something along those lines. But yeah, it's definitely a strong investment, or at least counter to inflation.
Yeah, absolutely.
For sure. Awesome. Well, thank you very much for taking this interview today. I learned a lot, and I'm sure the viewers back home learned a lot as well. And to the viewers at home, you can tune back into our West Bank Financials interviews on the YouTube and on the website as well. Thank you very much.